It's been 2 years since central banks printed trillions of dollars in response to a global pandemic, and now another destructive force has emerged: inflation. Today, the United States is dealing with its highest inflation reading in decades, and many of us, particularly younger generations, are getting a crash course in economics as prices rise. So it's natural to be concerned about the possibility of a hyperinflationary collapse in the future. For those who have never experienced hyperinflation, it can be frightening. Fortunately, some historical and contemporary parallels can help us prepare for and weather the storm if it occurs. So let's dive into today's video to know everything about hyperinflation and what one should do. And if you enjoy such content, make sure to like this video, subscribe to our channel, and turn on the notification bell icon to never miss another upload of ours. Here we begin. What is inflation? Inflation is a general increase in prices, and with fiat currency has become almost unavoidable, and central banks have normalized inflation to some extent. The panicked inflation is what we call hyperinflation. For instance, when an external event such as war, uprising, or a global pandemic, a government will fund its crisis response with debt. It cannot afford to service and print more money to make up the difference. Prices rise exponentially, causing consumers to panic buy anything that will hold value, resulting in massive shortages. To counteract the effects, governments print more money, and the cycle continues. Although hyperinflation is subjective, economists generally agree with Philip Kagan's definition of a monthly price increase of at least 50%. In fact, there have been cases that far exceeded that figure. For example, according to the Cato Institute, prices in Zimbabwe doubled in about a day from 2007 to 2008. Can we predict hyperinflation? Following the pandemic's recent years, it's easy to see how inflation affects stocks. Inflation and the stock market are inextricably linked, and the stock market can benefit the most from inflation in its early stages, so much so that inflation appears to be beneficial. The current rise in inflation is driven by the massive depreciation of the US dollar. In fact, the United States printed 35% of all the money in the country's history last year. The M1 money supply is spending money in your checking and savings account, under your mattresses, and lying at home. Hyperinflation is difficult to predict, but based on the current trajectory, many people believe the United States will enter another economic depression if the government continues to rapidly print more money in response to its mounting debt. Only the actions of the United States trading partners have prevented this downturn from occurring sooner. These countries have taken the necessary steps to devalue their currencies in tandem with the United States. This allows them to continue selling their products to US citizens at a price point that US consumers can afford. What are the causes of hyperinflation? Although hyperinflation can be caused by various factors, the following are the most common causes of hyperinflation. Demand pull inflation. A demand pull inflation scenario occurs when aggregate demand exceeds aggregate supply. This rapidly raises prices because there aren't enough goods and services to meet the increased demand from consumers and businesses. Hyperinflation is the result of a confluence of circumstances and poor monetary decision-making. Excessive money supply. The circulating supply of money is generally controlled by central banks. Central banks can increase the amount of money circulating in circumstances that historically warrant an increase in the money supply, such as a recession or depression. This action is meant to encourage banks, consumers, and businesses to borrow and spend. However, if the increase in money supply is not accompanied by economic growth, as measured by GDP, hyperinflation can occur. If an economy's GDP or gross domestic product isn't growing, businesses raise prices to boost profits and stay afloat. Because consumers have more money, they pay higher prices, which contributes to inflation. If economic output stagnates or shrinks while inflation rises, businesses charge more, consumers pay more, and the central bank prints more money. A cycle of rising inflation rates occurs, eventually leading to hyperinflation. What are the effects of hyperinflation? Hyperinflation can have several negative consequences. First, people may begin to stockpile goods such as food. As a result, food supplies may become scarce. When prices raise excessively, money loses value because inflation reduces purchasing power. With less purchasing power, consumers must spend more to buy less. As a result, they have less money to pay bills and less money to spend on necessities. Furthermore, people may not deposit their money in financial institutions, causing banks and lenders to fail. Tax revenues may also decline if consumers and businesses cannot pay, causing governments to fail to provide essential services. What are ways to prepare for hyperinflation? It's important to remember that hyperinflation is uncommon, especially in developed countries, where the central bank focuses on reining in and controlling inflationary periods. There are, however, some steps you can take to mitigate the effects of normal or high inflation on your portfolio. A well-balanced and diverse portfolio can help you mitigate losses during inflationary periods. For example, commodities and real estate can mitigate the negative effects of inflation because their value rises during these times. In addition, TIPS, or Treasury inflation-protected securities, can be used to hedge against rising inflation because the principal invested adjusts with inflation. Inflation hedging mutual funds and exchange-traded funds can also be used to mitigate the effects of inflation on your portfolio. Don't trust government readings, always verify. As Warren Buffett often says, don't ask the barber if you need a haircut. You can't expect unbiased advice from people with a financial incentive to deceive you. Governments cause hyperinflation by printing money to diminishing returns. Printing it is more politically expedient than raising taxes. Take inflation statistics from a government agency staffed by political appointees with a grain of salt. For example, the Consumer Price Index maintained by the United States Bureau of Labor is constantly changing. The reported changes are posted on the Bureau's website, and the notices frequently raise more questions than they answer. At shadowstats.com, you can easily see the difference between today's CPI algorithm and the one used decades ago. Beginning in January 2022, Consumer Price Index weighs will be calculated using consumer expenditure data from 2019 to 2020. The Bureau wrote in a February notice. The BLS considered interventions but decided to follow standard procedures. Of course, inflation is a complicated phenomenon with many factors such as supply shocks. But if you verify on the street, you'll have a better idea of how inflation affects you because at least you'll know the methodology. Focus on the bare necessities. Every day your money goes unspent during hyperinflation, you lose some of it. When purchasing power vanishes, it vanishes forever. So in hyperinflation, you're better off making major purchases sooner rather than later, because if you don't, those items will become increasingly difficult to obtain over time. If you're fortunate enough to live in a stable economy, it can be difficult to imagine this type of shopping. So instead, expect long lines at ATMs, empty grocery store shelves, and increased crime. Stay focused on the necessities you need to survive while shopping, such as food. You'll probably want to buy food with a long shelf life, so you can buy it in bulk without worrying about spoilage. When making a discretionary purchase, prioritize items that will likely become scarcer and thus potentially resold at a higher price later. You never know what the future will bring. Moreover, seek stores of value ASAP. When hyperinflation strikes, you are encouraged to invest your depreciating currency in anything that is a better store of value. In extreme cases, where prices double in days, almost any non-perishable item becomes a store of value. So for example, buying a couch and keeping your money in it, rather than in currency, is probably better. Hyperinflation generally means that market economies are deteriorating as time preference increase. This is because customers are encouraged to spend their money as soon as they receive it. People frequently seek to exchange their currency for another country's currency, but this can become untenable. Capital controls can be implemented once the government realizes what is going on. Forex trading could be made illegal or at least less profitable to save the failing currency. Russia most recently imposed a 30% tax on foreign currency purchases. We've even seen smoke and mirrors currency swaps, in which a country exchanges its currency for an even more devalued version. Bitcoin is one alternative that could be useful in times of hyperinflation. Bitcoin, like gold, is a decentralized bearer asset, making it much more difficult to seize. However, gold is far more valuable and can be sent to anyone worldwide at a low cost. It could be useful if you need to avoid capital controls during a hyperinflationary collapse. It might be worth getting some, just in case it becomes popular. Have an exit strategy. When faced with a threat, there are only two options: fight or flight. It may make sense to resist more openly when you have a good chance of bringing about change. On the other hand, when you know winning is a long shot, the smart move may be to avoid confrontation entirely and go somewhere else. Hyperinflation is a systemic issue, making it nearly impossible for individuals to make a difference. Finally, there is no way to combat hyperinflation. The best you can do is adapt and avoid its effects as much as possible. Trouble may be waiting on the other side if you figure out how to live with hyperinflation. As a result of hyperinflation, entire communities are squeezed and desperate people do desperate things. As a result, hyperinflation has been blamed for causing unrest, mass poverty, and war. In these cases, staying may not be in your best interests. For example, if you're a well-known Bitcoiner and Bitcoin turns out to be a successful inflation hedge, you may face scorn and even become a target. If this occurs, get out while the getting is good. Anticipation is the key to financial security. Markets are the sum of human decisions, and human nature is fairly predictable. So if you keep an eye on your economy and develop flexibility and resourcefulness, hyperinflation will not cost you as much. What do you think of this alert? Let us know in the comments below.